We've got markets at record highs, and of course some investors are thinking, should I take profits? Nobody ever went bust taking a profit, etc. Let's get some thoughts on a portfolio strategy from Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Great to see you.
Thank you.
Are you hearing that from clients? Kyle, should I liquidate some of my holdings?
Well, it's certainly been our approach to take the attitude that rebalancing is an investor's best friend, especially when markets continue to push new highs. I think from the indices level, we know that forward returns are likely to be more challenging given that valuations are stretched. Things are, again, quite expensive. The U.S., we've talked endlessly about how concentrated the S&P 500 is, the NASDAQ. Canada has some of the same issues. Really, for us, it's about how can we differentiate and make sure that we're able to achieve a long-term favorable return without jeopardizing too much on the downside if there is a pullback or volatility or uncertainty rears its head.
Say you had a long-term plan. Well, I'm going to be 70% stocks, reasonably aggressive. But if it grows to 80% of your portfolio, you should just grit your teeth and sell down some of that? Well,
certainly sometimes you're having to sell great performing stocks at a time where it might seem a little silly, but keeping in mind your overall risk profile is key. For us, I know we operate a strategy that is highly differentiated than some of the broader indices and even some of our peers. You look at, we don't necessarily brand it a global equity strategy or a global equity fund, but if you look at a typical global equity fund out there today, you have about 60% U.S. stocks. And a lot of that is due to the fact that the U.S. has been the place to be, and there's a degree of comfort there. For us, we're about 20% international emerging today. U.S., we're quite underweight relative to a lot of our peers and even some global equity funds that are out there. We're at about 37% today.
It's a lot lower, yeah.
Canada, we've been adding to, but we're still maybe a bit more neutral than we were even a few months ago. Really, for us, the strategy that we've been operating, what's interesting about it is the 5-year return on it is 17.5% annualized.
Okay, when guys talk about their returns, I always say, just go to the website.
Yeah,
anyway,
fair enough. You can learn more at TriDelta.ca, certainly.
Yeah.
But what's interesting is we've achieved some great returns without any exposure to any of the Magnificent Seven names over the last 5 years.
You haven't had any of the Mag 7 names?
Outside of this strategy, certainly, but within this strategy, we've looked at it as a true differentiator to be uncorrelated relative to the broader indices and that concentration that's there. We have several risk management tools as well that we're looking to deploy at the portfolio level and within this strategy. For instance, I mentioned the lower underweight U.S. position. Even within that, we use an option strategy to overlay that actually would have our downside if there is a pullback in U.S. stocks.
You got some ideas for us. This is one I'm not familiar with. Coterra Energy, CTRA in New York.
Yeah, so Coterra is a Texas-based oil and gas producer. They operate only in the continental U.S. They're about 60% oil, 40% natural gas. We particularly like natural gas from here. One of the reasons why we like them is they had an okay Q2 earnings. They're really strong operational efficiencies to bring down some costs, as well as they're looking to return greater than 50% of their free cash flow in 2025 to shareholders in terms of share buybacks, dividends, and also have a really great debt repayment strategy that we believe in. They fit our energy and asset value screens because they carry about a 3.4% dividend, trading at an 8 times forward earnings. And we think that they're a different pick that we actually just recently added last week.
And this was formed by a merger, I think, was it, originally? And I see that I'm just trying to work out where they are. Yeah, so they're a merger of Cabot and Cimarex, I think, which was a combination of Marcellus gas and Permian oil. And the yield almost 4%.
Yes, correct. Yeah, I think we're putting certainly an emphasis on dividend payers today, some of those more value names, rather than some of the growth areas of the market that have been driving returns more recently.
And then a company I've never heard of, Dentsply Sirona, X-ray is the symbol.
So they're a designer and manufacturer of professional dental equipment that dentists would use directly with patients. They also produce implants, aligners, and dentures for patients. Now, the dental market as a whole has seen softer demand in 2025. Part of that is due to tariffs. Part of that is due to actually some of the patents on Invisalign are rolling off, so there's more competition in the aligner space.
I'm sorry, they have the Invisalign brand?
They do. They have an orthodontics segment of their business. Now, they've seen relatively stable patient volumes. People still need to get their teeth cleaned, of course, but some of the slowdowns can be attributed to some of the bigger ticket items like those implants, the dentures, because economic uncertainty, maybe they're not willing to spend as much today in hopes that there'll be a bit more certainty later on. They carry almost a 5% yields, really cheap valuation. They're trading at about a 35% discount relative to their historical valuation. And again, that's another name that we actually added just last week.
Yeah, I mean, do they have some unique technology that do they? And also, I'm thinking a dentist, if they're happy with a supplier, they're probably not going to want to change.
Correct.
Because of all the hassle.
Well, when it comes to some of the professional equipment, a lot of it is standardized. So a lot of it is relationships with the suppliers and distributors and the dentists themselves.
Yeah.
But I think the biggest opportunity for them is likely on the implants and dentures and aligners. That uptick in their business can really drive sales and create a really great space for earnings.
My dentist was talking to me about his business the other day, and he's got a pretty big practice. It was just him. And I think he said, I've got to turn over something like $8,000 a day to keep this thing afloat. So it's a stressful profession. Thanks very much, Kyle.
Thank you.
Kyle Taylor, a wealth advisor and portfolio manager at TriDelta Private Wealth.